Good afternoon and welcome to the Winter 2021 Linneman Associates Capital Markets webinar presented by Linneman Associates and Real Estate Financial Modeling. This is your host, Bruce Kirsch, founder and CEO of REFM, provider of financial analysis tools and training to the CRE business since 2009. Today, we're pleased to have an insightful program for you, which will be presented by Dr. Peter Linneman, founder of Linneman Associates, which for those of you who do not know is a strategic and investment analysis advisory firm. We're using the GoToWebinar platform, and I'd like to address a couple of housekeeping items before we get started, just to make sure everybody's comfortable. On the audio front, all of the participant audio is muted, meaning we cannot hear you as a participant, and that's by design, and will remain the case throughout the entire webinar. If you're attending by computer, please take a moment just to familiarize or reacquaint yourself with the control panel elements of GoToWebinar. We are going to be showing the slides, but if you'd like to download them, you can find the handout section of the control panel and click on the file name and it will download. You don't need to have the slides up on your end because that's what we're going to be showing, but you're welcome to keep them for future reference. We have reserved 15 to 20 minutes at the end for participant questions, but please feel free to send your questions through as they arise through the questions field of the control panel. Make sure you type in the question and then also click the send button so that it arrives to us. And if at any point you get disconnected, just reconnect the same way you initially connected. If you are registered, you will automatically receive an email link to the recording of the webinar. And without any further ado, I'd like to introduce the presenter, Dr. Peter Linneman, CEO of Linneman Associates. Peter, good afternoon and welcome.
Great, Bruce. Good to be here. For those of you down in the area going through the power outages, our sympathies go out to you. So, and hopefully everybody is safe and well. So with that, Bruce, what we do?
Yeah, the number one question on everyone's mind is how are we doing and what's driving the current recovery?
Well, if you go to the next slide, I think, Bruce, is pretty simple. We talked about the butterfly recovery, and it has proven to be amazingly accurate. By that, I just remember it's a butterfly. They don't fly fast, they don't fly straight, they stop, they hover, they move back and around. That's what we've had really since September, and we're going to highlight that in several ways. What's driving the economy is this chart right here, Bruce, U.S. daily COVID deaths. And I mean, there's a lot of other twists to COVID, but that's it. Now, this chart, interestingly, is about 2 weeks old, and as you know, it is falling pretty rapidly. So even over the 2 weeks of data that we have not included, and of course this week's data when it comes out should be lower again, but you can see it's high. And I put up deaths because a death's a death, whereas we testing much more now than we were before. This probably gives a pretty true view of it. If we go to the next chart, Bruce, it's all about when people can do things that they'd like to do. Right now we have things that even if I want to do, the government won't allow me to do. And I'll take, for example, in Philadelphia, the Sixers play tomorrow night. Even if I want to go to the game, the government doesn't allow me to go to the game. I'm not saying good, bad, or indifferent, just true. And then there are things that even though we're allowed to do, we don't allow ourselves to do. So many places people are allowed to go to movie theaters and they're allowed to go to restaurants under restrictions and so forth. But many people are still choosing not to do so to stay safe. And that's causing a butterfly recovery. Namely, as people feel better, it moves forward a good bit, or as restrictions are eased. And as restrictions are imposed or people feel worse, it slows it down. And that's probably going to continue until we get out around the end of July. And the next is just math. If we did 25 million full vaccinations a month, By the end of July, we'll be about 175 million out of a 330 million person population. And then you remember you have to tack onto that, a lot of people have already had it, which is giving at least a good degree of immunity for some time. And then you put young children who seem to be reasonably safe from it. So it just seems to me by around the end of July, you'll start seeing where government restrictions become less. Hopefully in the next school year, schools will be able to be unambiguously open. Maybe the late holiday, summer holiday season can occur full bore. People will start coming back to work as these numbers are achieved. And they seem kind of far away, but they aren't really that far away. And then I think it's the Roaring 20s. A really good economic period takes off because of a lot of pent up emotion, a lot of pent up economic activity.
Well, we all like the sound of the Roaring 20s. Where are we right now? What's the situation today?
All right, so let's go through a few charts on the economy. Go to the next. The unemployment rate is probably as good as anything as a quick reminder. You see it for all workers as well as for just the young workers. And I always like the young because, as you can see, they're hyper reactors. The official unemployment rate shot up to unprecedented levels. The only time we ever got close to those kind of levels were back in the Great Depression. And you can see, I mean, they just shot up. And they shot back down, although what this chart doesn't show very effectively is that it has hovered a bit. So it's deceivingly low, the unemployment rate, though. And go to the next chart and I'll go through why. The unemployment rate, and I'm not saying anybody is misleading, but let's do it apples to apples versus a year ago. We had about 5.8 million unemployed a year ago out of 166 million person labor force. That was a 3.5% unemployment rate. The unemployment rate today actually is down to 6.3. Again, data came out since we made up the charts, 6.3% today. And yet, that can't be right in the following sense. There are at least 16 million people receiving some type of unemployment benefit. That's government data. At least 16 million, maybe as many as 20 million are receiving unemployment benefits. Well, if you use that as your numerator of 16 million, and you say the labor force should be by now about 167 million because the labor force would have grown over the last year, that would get you to around an apples to apples 9.6% unemployment rate. Another way to get it. A year ago, GDP was 3.5%. GDP is down about 6% year over year. You would expect employment to fall at least proportional to the drop in the economy. So a 6% drop in GDP would be about a 6% drop in employment. So you'd have the original 3.5 plus the 6%, that gets you to around 9.5%. Another way to get there, and these are all just triangulating on reality, is you have 148 million people employed today based on government data. That's probably slightly overmeasured because some people on furlough would categorize themselves as employed even though technically they're not. But put that aside, 148 million employed, and the labor force should have been around 167 million, apples to apples. That would be around 11.5%. So in an apples to apples sense versus a year ago, we're at least 9.5 to 11.5% unemployment. So we've got a long way to go. Go to the next chart, Bruce, and you can see one of the reasons is the labor force is down. And the labor force has fallen by about 6 million. those 6 million have dropped out of the labor force, not because it's wonderful. They've dropped out because what's the point of even trying? And so one of the ways the unemployment rate looks good is the labor force is disappearing. And if take the extreme, if everybody was unemployed except one person, but everybody who was unemployed was not part of the labor force, you'd have no unemployment. And I'm not saying it's that extreme, but that's a large part of what's going on. Go to the next chart. GDP, real just adjusting for inflation. We put a marker line just to help you see where the previous peak was. It was around 21, just slightly over 21 trillion. We're about 6% below that. The economy is very unusual in that, in fact, you go to the next chart, we'll zoom in. All the next chart does is just zoom in on the last year. So it's the same chart as you saw before, but just zooming in on the last year. And you can really see the butterfly phenomena here. We went from just under 21.5 trillion a year ago. We go down to about 19 trillion. We come back fairly quickly to around 20 trillion, and then it's been butterflying since then. And the reason it's butterflying is the sectors of the economy that are handicapped can't come back. Air travel, travel, leisure, tourism, entertainment, parts of education, they're handicapped until we get a lot of people vaccinated. So what you have essentially going on is maybe 10 to 15% of the economy can't grow, literally can't grow until we get a lot of vaccination. And the rest of the economy kind of moving forward a bit. And that's this butterflyness. You see it very clearly here. And we actually called this one right starting about September. Go to the next chart. Is one of the wildest charts I've ever seen. This is weekly unemployment insurance claims, and it goes back to 1967. And I mean, it's just a wild chart if you think about it. The spike that occurred as part of the pandemic shutdown is so extreme that it makes everything else look like nothing. And in fact, the unemployment insurance claims have come way down, but they butterflied around now for about 4 months at a 700,000 to 800,000 a week. And you say, well, 700 to 800,000 a week's not so bad, until you realize that's 2 to 3 times the previous peaks, including during the financial crisis and the early 80s and so forth. So I think this chart also gives an idea of how instant and how bad it was. A bit of butterfly phenomena. We've not made much progress on this of late, and it's still got some challenges. If you go to the next chart, Bruce, just staying on labor market stuff, again, you see we put in a marker line just to help your eye on where the previous high was. Private sector employment still down, about 6 million short, 7 million short. Got a good distance to go yet, and that's travel, leisure, and entertainment, a bit education. You say, what about education? All the professors are employed. Yeah, but not the janitors that are cleaning the buildings, et cetera, not the food service people. So you've got these really handicapped sectors, Bruce.
How are households doing?
People, huh? Imagine that. Well, it's an interesting, strange phenomena. Go to the first chart, and this is real net household wealth. Again, real simply adjusting for inflation per household. You can see a trend line, geometric trend line we put in, and more or less, we're on trend with our wealth. That is to say, there was an instantaneous drop in March and April. As you all know, that's reverted, and things have come pretty good on wealth. So if you had wealth, you've gotten it back. And if you didn't have wealth, you didn't lose any wealth, so you're no worse off. So on a wealth point of view, versus a year ago, people are the same to no worse off. Now, that's not to say no one is worse off. I'm just saying as an economy. If you go to the next chart, let's look at what happened to savings and debt. Okay, and we have the savings as a percent of disposable personal income. That's the blue. And that's the savings as a ratio of disposable personal income. And this is all indexed. So we've just indexed these to 100, indexed these. But what you can see is savings skyrocketed. Well, normally savings get destroyed during downturns. This time it skyrocketed. Why? There was nothing to spend money on. You got rebates on your vacation. You got rebates on your baseball tickets. You couldn't go on you didn't have to buy food at work, et cetera, et cetera, et cetera. And so the savings skyrocketed, unprecedented kind of spike in savings, just stunning. And it's mostly what I call involuntary savings. Involuntary savings was my vacation was canceled. Here's your refund. There's nothing I want to spend it on. I want to spend it on a trip. Well, I can't take a trip, so I saved it. So the savings skyrocketed, and it was a huge part of fueling home purchases. For years, you've heard me say that a big part of home purchases, you need a down payment. Well, when your savings rate skyrockets like that, people looked around and they had money to buy a home. So if they still had a job, and of course, many people did still have jobs in good sectors, most people still had jobs in most sectors. Interest rates were very low, but more to the point, they suddenly had changes in their lifestyle that allowed them to save in a way that they weren't willing to adjust their lifestyle to save. And that fueled single family. Now, the savings rate has come down a bit, excuse me, but it's still very high. And what you see is, though, that also the stimulus money that was given and the high unemployment compensation money that was given, people spent about half of that money and they saved about half of that money. So it's a very interesting phenomenon. And so the interest payments, the household debt, is actually quite low by historic standards. That is to say, people are in pretty good shape that way, Bruce.
I was just speaking with somebody earlier today, and they happened to be in the airport. They flew last week, and they said they were the only person at their gate for an intra-California flight, and every single shop in the airport was closed. And
yeah,
that's pretty shocking. So what's your thought on brick retail, and are we going to see it come back to what it was?
My answer is yes. So if you go to the first chart, you go back, and people forget this. You go back to February a year ago, retail traffic was quite good. So that, yes, there were retailers going out of business. Yes, there were weak retailers. But if you go back to the holiday season and a year ago, brick retail was doing good if it was good retail. This was a lot of work, a lot of effort, but it was actually growing in real terms. And then this is a metric of what happens. And you can see in March and April, retail traffic plummeted. And since then, it's really been butterfly, right? That's because some states have restrictions. Some states have indoor retail shut down totally at times. And by the way, I don't even feel all that safe shopping, et cetera, even if everybody's wearing masks. So retail traffic is down 20 to 40%, depending on things. And what I find interesting in that regard, and go to the next couple charts and then I'll come back to it actually. Everybody points out, well, real adjusting for inflation again, you can see the jump in e-commerce sales. I mean, you had this relatively nice trend and a spike, and you get about a 20% jump in retail sales and online. And I'm going to come back to that. You can actually see that it's moving a bit back to trend because it so went off the charts, so went off trend, it's going to gradually move back down closer to trend in my view. Go to the next chart. This is an estimate of real brick sales going back to 1999. And you can see, yeah, they went up and then they went down during the financial crisis and they got back up. And again, we put a marker line in to show you the previous peak of a year ago is the marker line. And it dropped dramatically with its hands tied behind its back by various regulatory and I don't feel safe decisions. But it's interesting that it has actually been bouncing back. Now, what it's doing is making up for some of the pent up that occurred. And let's go one more. What is happening to retail sales, e-commerce as a percent of all non-auto retail sales? Again, you see the spike, but the reversion back towards mean, back towards trend, you can see happening. And go to the last chart. I got thinking about this, and as you know, the narrative on brick retail is, oh, it's dead. Everything's going to be online. Oh, it's dead. Look how online just went up. Just look at the charts Peter just showed you. I played competitive basketball until I was about 53. And in open leagues, pretty decent open leagues. And I averaged about 8 points a game. I would like to believe that if my defenders had their hands tied behind their back versus normal defensive capability, I could have done more than increase my scoring percentage by my scoring average by 20%. I'd like to believe that if my defenders had their hands tied behind their back, my scoring would go by more than from 8 to 10 points a game. And in fact, to me, as I look at what happened to online sales during the shutdown and during the pandemic, what is striking to me is how little they've grown, not how much they've grown. I'm not taking anything away from the fact that they did grow, but they could only grow by 20%. They could only grow by about 3% of all retail sales when brick was in many cases shut, if not shut, highly restricted, and if not highly restricted, a lot of people very concerned about their safety. So I think as we get out there in July, go back to the vaccination pace we were talking about, I think you're going to see brick make a very strong return. Restaurants, theaters, movies, people are going to want to get out. They're going to want to get out when they feel they're safe and when they're allowed. So I actually think it's going to be a struggle, but it's got a good outlook out there.
Just curious, anything in particular you think that prevented retail sales from being even stronger when the brick was not allowed to be open?
Oh, yeah. I think it's as simple as people like shopping in bricks. I mean, yeah, I think it's that simple. In addition, it's very difficult for online. They can't sell groceries profitably. They can't sell high return items profitably. They can't sell low margin items profitably. What is it? Amazon and Walmart, I think I'm right, have both instituted, don't ship it back to us, just keep it. What a business model. Order 7 blouses, and whatever you do, don't ship them back to us. That it shows the difficulty they have on high return, high handling cost, high shipping cost items. So you take the social dimension and the fact that online just has a hard time with tight margin, high return items. It's a challenge. Remember, 3% of all retail sales are groceries, and they can't sell those profitably online. 4% is eating out. 4% is eating out. And I know Grubhub and so forth and so on, there are limits. You know, I think people want to go out. I live in Philadelphia, and I see these people eating outside in these little pods when the temperature is 32 degrees. People want to eat out. They want to eat out. Nobody's eating out in 32-degree temperature because they don't like it. You know, it shows how extreme people want to do.
Right. What about returning to the office?
Of course they're going to go. Of course they're going to go. I mean, but not until it's safe. It's safe to get to the office, so that means it's going to be slower for the places that rely on buses and subways, but they're going to go. The places that have handled COVID best, I was talking to somebody down in Bermuda who has handled it quite well, and they have high restrictions. People go to work. People go to work. They go to their little office in their little Bermuda shorts. The international evidence, which is limited, is people go back. Why? Because productivity is higher for most people. Not everybody has a beautiful office they can work in with quiet and a serene view. A lot of people have crying kids, and they have dogs, and they have craziness. And by the way, they're not that disciplined to start with, and they're easily distracted, etc. So productivity is one reason, and the other is competitive advantage. What do I mean by that? Right now, I'm at no competitive disadvantage working from home versus my competitors or my peers. But now imagine people start going back to the office and I'm not. They have a competitive advantage. They have a true competitive advantage. If I try to hire you, Bruce, and somebody else tries to hire you in person in the traditional way when life is safe, I know who's going to win. The person who brings you in and you meet 5 people and they take you to dinner and wine and dine, they're going to win. If what I do is get on Zoom for 35 minutes with 3 different people, you're not going to be as impressed. I need to win talent. So right now, there's no competitive disadvantage of working at home because everybody is. The other is we couldn't have been that wrong. What do I mean by that? You can't convince me that suddenly in March, we all went, oh, you know what? It's a much more efficient way to generate business by working at home. It's not believable. It's not believable. We couldn't have been that wrong. Social, we want the social interaction of the office. Most people, not academics, not maybe writers, but most people want the social interaction of an office. They want to protect themselves in office politics. What do I mean by that? I don't mean Democrat, Republican. I mean, who's getting the plum assignments? What are they saying about me? Well, if you're not there, you can't protect yourself from office politics. And then there's this old phrase, Bruce, that, you know, I'm taking the married version of it, but I'm sure there are many relationship versions of this that go for better or for worse, but not for lunch, especially every day. So I jokingly, but only half jokingly say the reason we're going to go back to the office is our partners want us to.
I think a lot of people can relate to that. What about hotels? What's going to happen? Lodging.
Yeah, you know, again, of course, they're going to rebound when travel is safe. We're social animals. We're curious. We've been traveling for a millennium. We will continue to travel. Surveys are kind of showing one of the things people miss most is travel. People say, but business travel and conventions. Let's be honest. Conventions and a lot of business travel, some of it is a perk for the workers. I mean, a lot of people like going to those conferences, those conventions. They like interacting. And in fact, it's a way of employers giving perks to their employees. You add to that the competitive advantage. You try to get a customer online and I go out and do it in the traditional way. Yep, I have to fly out there. Yep, I have to spend a night. I have to get on a plane. That's not so hard. I work while I'm on the plane. I do things. It all kind of does okay. Right now, there's no competitive disadvantage or advantage. When it's safe, going out and visiting customers and going to conventions and conferences and so forth will be a competitive advantage again. People are hungry for leisure experiences. International will be the lagging component, which will hurt DC. It'll hurt San Francisco tourism. It'll hurt LA tourism. It'll hurt Disney tourism, Vegas tourism for a little bit, because the governments are going to be slow to allow people to do it relative to when they're willing to do it.
Great. I just want to remind folks, please send questions through as they arise. We have some great questions coming through already. Just fill in the field in the questions form. Make sure you hit the send button. And we've reserved some time at the end to talk about those issues that you're bringing up. Let's talk multifamily.
Multifamily, a year ago, already had softness in urban core property, not because of weak demand, but because of excess supply. Too much had been built. We got ahead of our got out of our skis on that. And then what happened is pretty simple. All of the negatives of a city still exist. And in fact, even more so, given some of what's went on. But what happened is almost all of the positives of a city disappeared. I can't socialize. I can't go to people's homes. I can't go to the concert. Can't go to the ball game. Can't even go to restaurants in many cases. So the positives, the amenities disappeared, and the disamenities or disadvantages, if anything, got greater. Is a surprise that in the near term, people said, I don't need to be there until the amenities come back. So, whereas in the suburbs, they never had all those amenities. What they had was the amenity of space and openness, etc. They didn't lose those amenities, and they didn't really get more disamenities, so they become relatively more attractive. And as we talked about, the involuntary savings fed single-family demand. Decent demographics, though, are still feeding multifamily, particularly in the suburbs. As the cities come back with their amenities when things are safe, I think you'll see a balancing. It'll take a couple of years in the urban core, though, for that to happen. The near term is supply has muted a bit, and that will help things balance out.
So how does this all impact commercial real estate values?
Well, hopefully it's not the fire, although single family is on fire. On the other hand, you have things like, if you go to the chart of the private real estate values, most of these jigs and jags, you want to look at the general pattern on them. I mean, retail is clearly down. Office clearly down over a year ago. Industrial up a bit over a year ago. People feel pretty good about it. Go to the next chart, and we have multifamily. And multifamily initially dropped as the shutdown occurred. It's come back a bit, not quite as hot as it was, though pretty hot in the suburbs. Hotel fell apart, just fell apart in March, April, May in value. It is coming back because I think people are starting to see light on the other side. If you go to the next chart, it does implied cap rates versus a year ago for REITs and versus the end of year for REITs in different property categories. And the simple statement is multifamily pretty much unchanged. Cap rates up slightly on Wall Street. Shopping centers, though, the cap rates are up. Malls, the cap rates implied are up. Office cap rate is up. Industrial down. And that industrial is reflecting the strength of online. That online demand filled a lot of properties that way. And I think what happens to values from here, go to the next chart, is as the risk recedes. Right now, we still have bad times ahead of us in these properties, like hotels and offices and such. You still have difficulty. So as time goes by, the worst cash flows are behind us. So that will push values up. Secondly, the discount rate will fall. Why will the discount rate? I don't know for sure people will go back to the office. I think they will, but I don't know for sure. As they actually do go back to the office, the discount rate will fall. If you think about it as a discounted cash flow matter, as people do travel again, and as they do travel again for business, not only will cash flows increase, but the discount rate will fall. And when you add to that lower interest rates, so I think as we get late into this year, and people do go back to travel, and they do go back to the office, and they do go back to shop, not only will the worst cash flows be behind us, and that pushes values up, but you're getting discount rates down. On top of that, all of this liquidity that's been injected into the system, and it's stunning, will start slowly coming out, and it's going to chase assets. And I think you're going to see values rise, and the secular trend of cap rates is going to be downward. And that's because we've jammed a tremendous amount of money in the system, and that's going to want to chase assets. It's not going to chase goods and services nearly as much as it's going to chase assets. That's the lesson of 2009 to 2019, that the money chased assets and bid up prices, not goods and services. And I think 2 issues ago in Linneman letter, we had a piece, Matt Lariva and I, Matt at FCP did, on the empirical evidence is just very compelling that cap rates are determined by the flow of funds chasing product. And there's going to be a lot of funds over the next 5 to 10 years chasing real estate.
We have some folks sending questions through about the rise in the federal debt. What are your thoughts on how we can afford this, and what are the implications behind how it's growing?
All right, well, I'm running a little long on time here, so I'll try to do this quickly. Look, you look at the next chart and you see federal debt per household. It's up a bit. It's up a bit, right? Federal debt per household. If you go, so we got a lot of federal debt per household. Go to the next chart. You can see total debt outstanding. And you can see, again, the government debt, the kind of aqua, shoots up pretty dramatically in the last year. We got a lot of federal debt. You go to the next chart. You can see that the federal budget deficit, we broke it into eras, if you will. Federal receipts, federal expenditures as a percent of GDP. And you can see there was a drift of not so much more receipts as a percent of GDP, but a lot more spending as a percent of GDP. So you go, well, how? And you go one more chart. And you go one more chart, and this is federal debt as a percent of GDP going back to the founding of the nation. And you can see that generally it gets high around wars. We get a lot of federal debt around wars. Originally the Revolutionary War, the War of 1812, the Civil War, World War I. It gets another jump from the Great Depression, a huge spike from World War II, still unsurpassed. And then you get this phenomena of what we've recently witnessed. And we have essentially the same federal debt as a percent of GDP as we did during World War II. Now, we're a much richer country than that. So if you go to the next chart, this is all simple math. If ultimately COVID cost us $5 trillion of additional federal debt, and by the way, CARES 1 was what, 2.2 trillion, I think. CARES 2 was 900 billion, so that's 3.1. You add another package or so of CARES 3 or 4, and you're up to 5 trillion, more or less. That's only about 4.4% of our current wealth. 5 trillion is only about 4.4% of the current U.S. Household wealth. Not so big. It's only about 0.6% of the net present value of U.S. GDP. And in Linneman letter, we go through this math a little more. It's about 0.25% of GDP in terms of interest service, the $50 billion. We can service the $5 trillion additional debt for an annual interest outlay of about 50 billion a year. That's 0.25% of GDP. It's 1.2% of the entire 2019 federal budget. So I'm not trying to say 5 trillion isn't a lot, certainly is, and I'm not trying to say 50 billion in annual interest service isn't a lot, but it's nothing if what we're able to do is borrow from our future to alleviate the pain and suffering and to stimulate the research of today. It is not about stimulus, however. It should all be about targeting relief. CARES 1 was quite highly targeted. CARES 2 adequately targeted. CARES 3, as drafted, is going to be far less targeted. And, you know, look, the person making $50,000 a year working for Microsoft, they don't need stimulating. Microsoft doesn't need stimulating. The person who needs help is the person who couldn't get a job after they graduated from high school because restaurants don't hire, because all the restaurants are shut, or the person who couldn't keep a job at the airline because nobody's flying planes. Those are the people, those are the sectors. It's very targeted. It is not about stimulus. It is simply about relief.
Let's switch gears to capital markets and talk about money supply.
All right, go real quick on this then, Bruce, and we'll end on this. Go to the next chart and you'll see the money supply. It's jumped no matter how you measure it with M1 or N2. Very big jumps in the money supply. It is going to go somewhere. Now, if you go to the next chart, consumer price inflation, whether you measure it by core CPI or for services, all items, you can see the average over has been about 2.5%. We're below that average. So far, it is not coming out in goods and services. Go to the next chart, and I'll tell you where I think it chases. You see QE1, QE2, QE3 that took place from 2008 through 2014. You see the money went into the banking system, really into the major money center banks. You see this unprecedented growth in the monetary base. And people like me, including me, said there's going to be a lot of inflation. Well, we never got consumer price inflation. You can see the monetary base shrunk from 2015 to a year ago as that money started to come out of the banks and into the system, really started to flow in the system. And you didn't get consumer price inflation, but what you got was asset price inflation. And that's because the banking system of today in the United States is not set up to fund people buying Wonder Bread and Coca-Cola. It is set up to fund companies buying bonds in Coca-Cola or buying companies that make bread. Much more so than it is set up to fund individual goods and services consumption. So we've got QEfinity, which has added another sort of doubling of the amount of monetary base. I think it's going to come out again in terms of chasing assets. Go to the next. You can see banks. This is reserves in excess of the required in the system. By the way, if you go back prior to 2008, it's not a false chart. They were zero. Banks had no excess reserves. That meant if anybody didn't pay their loan, the banks were in a bad way because they didn't have enough capital. QE1, QE2, QE3, and now QEinfinity have put tremendous amount of reserves in these banks so that even if people don't pay their loan, they're not regulatory short on reserves. And you can see what happened is you see these reserves build up, build up, build up to 2014. And then they start really coming out from 14 to very early 2020. And as they came out, they chased assets primarily. And you saw asset price inflation, gold inflation, home price inflation, real estate price inflation, stock market inflation, bond market inflation. And this money has established a new norm around pricing. And we put a whole bunch of money back in the system. So you go to the next chart, you've got treasury bonds, long, short, intermediate are very low interest rates. They're going to stay low a long time. The Fed's going to push them to stay down there. Go to the next chart. Again, go back to the research. This is the index of outstanding mortgages, including multifamily, commercial mortgages, including multifamily, relative to the size of the economy. When this rises is when you see cap rates fall or maintain. When this falls is when you see cap rates rise. And that's what all the research is. And you can see that this has actually gone up. And so there's a lot of liquidity out there. You can go to the next chart. You can look at the total amount of multifamily debt. There's a lot of multifamily debt out there chasing assets. And so far, if you go to the next, for non-multifamily commercial, it hasn't fallen. And until it falls, cap rates will hold. And go to the next, one more chart. I'll end on this. Will there be opportunities? Will there be opportunities? And I started saying about, I guess about May of last year, I don't think there's going to be a lot of opportunities because banks have been given all those reserves, and you can see the amount of reserves they've got. And they're being told by the Fed, we did not give you these reserves to foreclose. We gave you these to forbear. Forbear, forbear, forbear. Not just on real estate, guys, forbear. Forbear on all your borrowers as much as possible. And the only time that gets difficult is if you have negative operating income. Because it's one thing to forbear or sweep your income to do service. And it's another thing to say, dear bank, fund their shortfalls. So if there are shortfalls, operating shortfalls, that's a challenge. Or if it's a non-bank borrower, that's a challenge. But they were given these reserves explicitly to forbear, and I think the forbearance continues. And yes, bad borrowers might get squeezed out by a bank, but by and large, forbear, forbear, forbear. And with that, Bruce, I think we ought to stop and time for a couple of questions.
Yeah, terrific. Thank you so much. So we've had several folks write in about industrial seeing a day in the sun, and when do we think that that tailwind is going to stop, not stop altogether, but when are they going to stop having this unfair advantage maybe?
Well, there were two pieces of mathematics that work for industrial. One is every dollar sold through an online channel uses about 3 times the warehouse footage as if it was sold through a brick channel. So as sales were migrating prior to COVID, as sales were migrating, that math was fueling a lot of demand at a kind of threefold factor. And it took a while for the industry to catch up to that, for developers to catch up. Then on top of it, just as developers were starting to catch up, saying, oh, we've got to develop 3 times as much to satisfy the incremental demand, you saw what happened to online sales. They spiked. Well, you couldn't keep up with that. So I don't think that it's going to be the demand side that's going to trip up industrial. It's going to be the supply side. Namely, give us enough time and we're going to oversupply it. And in particular, that's why I was noting that I think the share of sales online drift back down on trend. And if you think instead that that jump is permanent and establishes a new trend, and that's what you build your industrial to, you're going to be sadly mistaken. And we're going to end up with a lot of excess supply. And the thing is, industrial is one of the few things you can get a construction loan for right now. So there, I like the sector long term. It's not anything wrong with it long term. It's just that we will overbuild it. So overbuilding is the thing to keep your eye on there.
We've had a few folks also write in with respect to senior housing and how that demographic wave is not going to change. What are your thoughts on the strength, continued strength of senior housing?
So the oldest edge of the baby boom is about 74 years old. And the mistake that the senior housing sector made pre-COVID was saying the baby boom is aging, which they are, but they're also staying healthier and they're wealthier. So the combination of those was, yes, they're going to get there, but they're not going to get there until they're 78 to 82. That demographic still has some time to go. And in fact, if you go, who's 78 to 82 right now is somebody who was born basically during World War II. And that was a baby bust era. The World War II era was, not surprisingly, a baby bust. So the demographic, and I've said this for years, the demographic in the near term, the very near term for senior, is not a great demographic. It's the World War II generation, birth in the World War II generation. It's 6, 7, 8 years from now is when the baby boom really kicks in to that category. Until then, you've got a bit of overbuilt product to start with, and then all the COVID-related concerns, you don't really want to put grandpa where he's going to die. You'd like to visit him. And the fact that you can't visit and they might die is a damper. Now, the vaccines will change that latter part enormously. And the most disturbing fact that I've seen for senior housing outlook in the near term is apparently 30 to 50% of care workers are not choosing to get vaccinated. And if I'm an operator of one of these facilities, that's a very disturbing phenomena. And I think some combination of government's going to have to say that if you're going to care for people, you need to be vaccinated, or the private employer saying, if you're going to care for people, you've got to get vaccinated. But I'm hesitant to put me or the generation ahead of me into a facility where I think 30 to 50% based on the surveys have not gotten the vaccine even though it's been offered. That's a disturbing phenomenon for that sector, and they've got to get their arms around that.
Great, thanks. A few participants have written in regarding consumer confidence. Consumer confidence, one of the charts we typically show, and I'm sure that it's covered in the Linneman letter, but do you see any change, or has there been any significant change since the administration change in consumer confidence?
Not notably. The new data the data for January is not quite out, but you haven't so far seen great signs of it one way or the other. I'm not trying to minimize politics, but I think fears of COVID and shutdowns and can I go to work and can I go shop, can I go to my child's wedding, those things trump, no pun intended, any political phenomena pretty dramatically. The interesting phenomena to me has been how high consumer confidence. It's right around average. And I would think you would have like 85% of consumers around average and 15% way below average. Net, it would be below average. But it's actually an aggregate right around average. Maybe we have time for one more, Bruce?
Yeah, I was going to say one more. We've gotten a number of questions related to our ability to fill jobs without the same immigration levels. What are your thoughts on that?
Well, in the near term, it is not a huge concern, although obviously for particular jobs, it can be a concern. I'm on record my entire career as being a huge proponent of legal immigration. I've always thought we should make it quite easy for law-abiding people who are willing to come and join our society and enjoy our freedoms and our opportunities and abide by our laws. Thank God they allowed my ancestors in, right? And I think my family has more than repaid the country for letting us in, and I think that's Kirsch is a German name, so I would suspect the same is true of you, and so I'm a big proponent. Obviously illegal and so forth, but we've got to make it, we want to be a beacon of hope. And we don't just want to be a beacon of hope in the world of send me your tired, and so forth, for some do-good reason. That's probably true as well. We want to do it to make this country great 20 years from now and 30 years from now and 70 years. So I gave a speech, Bruce, at one point about 10 years ago. And as you know, the immigration thing comes and goes as a hot button. And I said, and I was speaking to an audience of about 500 people in a hotel ballroom. And I remember saying, we don't need immigrants to fill this room today. As a group of industry leaders, it's kind of people who are listening to this. We don't need immigrants today, to fill this room today, we needed to fill it 20 years from now. We need immigrants today to fill it 40 years from now. We need immigrants today so that their children and them as well, them and their children and their grandchildren, fill it 20 and 40 and 60 years from now. And I was very disappointed in the Obama administration immigration policies by and large. I was very disappointed in the Trump administration immigration policies by and large, and I'm hopeful that we become a more welcoming place. We'll see. We'll see.
Great. Thank you so much, Peter. As always, very interesting thoughts, and we appreciate your time. Unfortunately, we're not going to be able to get to all the questions, and we do appreciate folks sending them in. I just want to make sure everyone does know that this presentation is really just a very small taste, and it's just a digest of what's presented in a lot greater detail in the Linneman letter, which is a quarterly hard copy publication from Linneman Associates. And you can find more about that at linnemanassociates.com, as well as learn about the refi certification program and the educational video series offered by Linneman Associates. Again, the website address, linnemanassociates.com, and also for REFM, getrefm.com. We want to thank everybody for joining today. Please stay safe, stay healthy, and we'll hope to see you back next quarter. And thank you again, Peter.
Thank you. Always fun.